Hello, everybody, and welcome to episode number 65 of Confessions of a Market Maker. I'm your co-host, Ray, AKA All Day Ray, AKA Broadway Billy, and I'm joined here by my buoyant co-host, former market maker of 20 years and current day retail trader, a man who's been described as a mix between Meyer Lansky and Naval Ravikant. I am talking about the heartthrob of Eastern Europe, JJ. How's it going?
Hey, Ray. What's going on, brother? How you doing?
I'm doing good, man. Hopefully you're feeling all right. Today,
death is sexy, man. Death is sexy, brother. You know what I mean? That's what makes my heart throb.
He is, man. The Eastern Europe loves this guy. It's anyway. Our guest today is a man who's been profiled in Jack Schwagers' latest Market Wizards book. A man who has achieved an average annual compound return of 42% in 10 plus years, the author of The Global Macro Edge and former bookie, the man whose favorite the man whose favorite day is Monday. Of course, I'm talking about John Netto. John, how's it going, man?
Well, it's not Monday, but I'm still having a good time. Okay, so yeah, we're doing good.
My man. Thanks for joining us. He's got on the Golden Knights shirt. How they been doing this year? I haven't been following too much.
Crushing it. BGK's crushing it. We're gonna go claim the cup this year, baby. We're taking it down. Best home ice advantage in all of hockey. Vegas Golden Knights.
It's pretty incredible, John. It's how much the city really got behind the Knights. I mean, maybe not surprising. What do you think?
Not surprising to natives. I'm blessed enough that they practice about a mile from my house. I live in a section called Summerlin, this planned community here, and the Knights Arena, Citibank Arena, they practice as close by. So it's a real communal sense. I would take the accounts from the players themselves for the Golden Knights, and that the NHL players who've come from all over the league have described it as like just a spirit and a fervor and a passion that's like none other that they've seen. And that's saying a lot given the Canadian contingent of players that are on the Golden Knights, because obviously Canadians love their hockey. And for them to like rate the fan and the energy of the Fortress or of T-Mobile Arena, which is where the Golden Knights play, as like the biggest home ice in hockey for a city basically that is desert, that is landlocked by desert, it's pretty cool.
Yeah, no, it definitely is. How about the Raiders? I know they couldn't have any fans in the stadium. I think the NFL's planning on getting fans. You think we're going to get the same energy around the Raiders?
If not more. I mean, I think the novelty of football is that because that the games are events, right? Like you think about college football, pro football, the tailgating, whereas baseball is more like a series of events or a series of inputs that determines the winner. Yeah. Football, because it is such a compressed schedule, now 17 games. These are events. People plan a year in advance to come to one game. They plan a weekend around it. And there is no better, entertainment infrastructure than Las Vegas when it comes to facilitating that, when it comes to facilitating this festive atmosphere. And you're in the Northeast, or you're in the, another part of the country, and it's November or December, you're going to travel to Las Vegas, and you need an excuse anyway. Now the Patriots the Chiefs are playing, or, the Packers are playing. I mean, think about the following of these teams. So yeah, I think the NFL is going to crush in Vegas. I think that the Vegas atmosphere will be like one of those sort of out of body experiences, frankly, for those that attend the games. And as it's been for the hockey side, I've been to a couple of hockey games and they're just incredible. Imagine NFL will be at the same level.
Yeah. No, and to your point, I already looked if the Jets were playing out in Vegas, my team. So I plan on doing the same thing. I mean, it's incredible. John, I thought it was funny how Jack made a point to preface before your chapter of how hard your chapter was to compile. Yeah. How was the interview process for you from your perspective?
Like many of my other interviews, ad lib, impromptu, spontaneous, free flowing, extemporaneous, those things, because there's a lot in this brain, and my mouth is the bottleneck, and I want to get it all out. And but I sort of managed when I trade to synthesize this information and put it together and combine it with an intuitive, sort of qualitative, holistic process. And what you get is like Jack Schwagers, who interviews you like you would expect from an engineer. Okay. And so when he interviewed me, it happened over 2 different days. The first was a 6-hour sit-down interview, followed by another 4-hour follow-up phone interview. Okay. And Jack is incredibly thorough, like engineering-like thorough, wants to get to the details, wants to understand to the extent that you want to share with him, of course, because a lot of us market wizards, and I use that term, in quotes, have proprietary information that while we definitely like sharing the concept or the spirit of something, the nuance and the details is where a lot of the alpha lies. And so I'm all about sharing how people get it the right way, but I'll teach you how to fish, but I'm not going to teach you the spot on the pond and what time in the morning to go there. You know what I mean? To come up with it. All right. And so there's a little bit of that balance and that tug, but Jack is very, Jack's a great interview and he's very detailed. Like he'll call you out on stuff. Like what you said this earlier, because he doesn't want any bogus stuff in his book. And I enjoy that. I enjoy the rigor that he puts into it. So he was very rigorous. He reviewed all my personal account statements for, he had 10 years of account statements he reviewed for me. He reviewed a certified audit from a CPA that went over my performance, my personal account. And he asked about this. He said, tell me about this drawdown here. How do you explain that there? How's your theory evolved? Or how's your strategy evolved? How have you evolved? And all of these things, I would just describe it as incredibly comprehensive. And it was, he made me think sometimes like, why do I do that? And I often come back to, sort of the manifestation of my, 30, 40, 50,000 hours of market work and frankly, life experiences, because our life experiences really formulate and shape how we trade beyond more than what we may give them credit for.
Absolutely. And I think that's what your chapter really touched on, and we'll get into some of that. Just a reminder to the listeners, if you guys would like to trade alongside JJ and myself and a professional group of traders, join us at microefutures.com. John, you had I joked in the beginning, but actually you're a bookie, you had a successful, run in high school until it blew up. But it seems like this kind of maybe sets you up for like a lesson later on in life.
Yeah, I as I talk about in the Unknown Market Wizards book, I ran a bookie operation, or I provided liquidity for those wishing to prognosticate on the outcome of sporting events.
Well said. Yeah, well said.
Nice disclaimer.
That's what law school does to you, by the way. All right, you find ways to recharacterize things. So yeah, that's what I did, and I think a lot of us, all of us here, and I imagine most of your listeners, have the gene that you have, contributes or facilitates a penchant for taking on risk, right? And we all love taking on risk. And the idea that I was surrendering my power as a bookie, because in some sense that's what you're doing. As a market maker, that's what you're doing to some regard. Like you are surrendering some of your decision-making power, some of it, because you're facilitating liquidity, you're facilitating order flow. And that order flow is determined by the counterparty in that case. Okay, so for me in high school, the idea that like the other person got to pick was like, I don't know, that loss of autonomy was something I had to reconcile at first, but it was as counterintuitive to what we might think. The fact that it proved to be profitable for most of the time, sans some more rigorous risk management, and I would also say counterparty risk, because I was letting people bet on credit, and I would say that their credit worthiness was high, and part of the issue I faced was that the people that owed me money didn't pay. You know what I mean? Whereas the people that wanted to get paid. And you can have an 11 to 10 edge, but if the people who lose don't pay you, then it will not only negate that edge, it will like turn it into a negative expected value situation.
Right. And that's what you ran into. You ran into an event where it was like 24 out of 26 winners, right? Yeah.
It was COVID in March 2020. You know what I mean? Like it came and it was, whoa, these 2 delta puts on the S&P are now like 100 deltas. What happened there? Like
what I think, and you tell me what you think, and what this, because I feel like this is a lesson that can be learned in trading, right? And this is something I learned from poker, is you start to understand how we can underestimate or maybe overestimate these low percent chances happening, and protecting yourself against these scenarios.
Right. And so there's a couple of factors to that. One is we not only underestimate these chances of happening, but we also underestimate the asymmetrical nature of this risk as well. Okay. And so I think a lot of people mistakenly, like you'll hear advertisements of systems say, oh, I win 80% of my trades, I win 70% of my trades, I win 90% of my trades. But what's more important to me is the profit factor behind something, because it's net, what are you making basically, which effectively is what the profit factor determines. Like, well, great, you had 10 wins where you made $50, but 3 losses where you lost $60. So net, you're down 10 on whatever, 13 trades. So you have a profit factor that's actually negative, or whatever. Like my point though, in terms of measuring the net effect of that. So I think that case comes into play when you're talking about these, like not only the low appreciation for this risk, but then the sort of damage it does when that event hits. Okay. And I think that's where a lot of the disconnect comes for people, and where I kind of try and hit that on in the book, my book, The Global Macro Edge, Maximizing Return Per Unit of Risk. It really is the concept of how do you maximize return per unit of risk? Well, the first part of that is defining what a unit of risk is. What is it you're risking? Because, what we see in the investment world, and this is, to the chagrin of trillions and trillions of dollars, is I give you, $1 million to trade, okay? And a lot of us come from the absolute return world. The market maker world is like, okay, what are you making or losing relative to the risk I'm giving you, right? And so, okay, if I give you $1 million, I might say to you, okay, listen, dude, you can lose 200 grand of that million. That's your stop loss. You can't lose the whole million. The million's there for buying power and margin purposes, but I'm only going to lose 200K. Now go to the next guy, maybe a more passive investment or traditional portfolio manager. He may have the whole $1 million. There's no risk budget behind him. He can just lose $500,000 of that, or, all of that. And no one really talks about these sort of tough, preemptive conversations about, well, where am I going to stop you out? Don't happen. Whereas maybe you and I have $1 million and we can only lose 200 grand of that, and we know that up front. So that unit of risk for us is 200K. For someone else, it might be $1 million. But here's the worst part: is that now that $1 million falls by 300 grand, the investor comes in and says, "Oh, well, I'm going to pull it from you." And you're like, "Well, why are you going to pull it from me?" Well, because you lost 300 grand. Well, but I didn't know if I lost 300 grand, I would get pulled. Otherwise, I would have behaved differently. And so you get investors that end up making these emotional decisions to either chase a hot strategy or withdraw from one or pull money from one, which is not training because they simply didn't set a risk budget. And we as a manager, if we know what our risk budget is, if we know at what point we're stopped out going in, we're gonna manage risk accordingly to that. So my whole concept, so to your question about, rare outside events, I think it's part of a broader discussion of, well, how do we approach risk in general? From a portfolio level, from a trade level, from a strategy level. If I'm running 5 strategies in my portfolio, each one of them needs a risk budget. I'm not going to put a risk budget on the upside, but I'm going to put a risk budget on the downside,
Right, absolutely. John, you were a Marine for 9 years before you got into trading. Do you think I would imagine there's probably certain things being a Marine prepared you very well for in trading?
Yeah, and life for that matter. Sort of following up on the bookie story from high school, I didn't have a very good grade point average. I had a D plus C minus average in high school. I was running a full-time gambling operation, which took my attention and my passion, away from, but I did go to school because I had to meet my customers, so I stellar attendance, okay? And the classroom was a place to sort of, hang out and do what I had to do, but it also sort of contributed to this sense of, this lack of discipline and this lack of accountability, and the Marine Corps was not going to have any of that, okay? And it was an awakening. It was a rebirth in many ways. And, the Marine Corps allowed me to go to Japan, where I learned to speak Japanese and ultimately Chinese. They paid for my education at the University of Washington, went through officer candidate school. It was an existential experience, to say the least. And I'm forever grateful for that. And once a Marine, always a Marine. And we actually took the profits from the book because of my Marine Corps background and because of what I saw firsthand, and actually donated it to purchase, help 8 different service dogs go to military veterans with PTSD, which is having had colleagues of mine that went to fight in Iraq and Afghanistan, I saw the effects of that, and we need to do everything we can for our men and women veterans out there who serve bravely for us overseas and domestically.
Yeah, absolutely. Yeah, and shout out to everyone who served, and yourself too, John. Thanks.
Thank you.
Yeah. So I'm just curious because I've had some buddies who joined the Marines, and just talking to that initial training. What was that experience? Did you go in prepared? Were you an athletic person growing up? What was it like?
Yeah, more athletic than I am now for sure. I was 18, joining the Marines. I did a lot of running and elevation. So there's 2 boot camps you can go to. There's San Diego or Paris Island. I grew up in California. I'm a West Coast Marine. I'm a Hollywood Marine, as they called it. So I went to 1993 and 94. So I'm 46 now. I was 18 when I went then. So you're talking 28, 29 years ago. But it was just intense. You're dealing with no telephone, then we didn't have the internet in 94. That wasn't a thing. At least the mainstream knew about. And, you know, one phone call 11 weeks in, which you can just imagine. I mean, I felt like, whoa, with no phone call to my mom or my dad or my brother. I can only imagine today what that's like. I mean, maybe on visit, maybe every Sunday they let them, you know, access their smartphones. Now I have no idea what they do, but it was just, now you're talking about your drill instructors are going to find your weakness. Your drill instructors are your people who are in charge of you, and they're the mean people that scream that you see from all these movies and stuff, and they push you to a level you can't get to, frankly, without them, and it's incredibly stressful. And they want to see how you handle the stress, you know, and that's the rub there, you know. So yeah.
Yeah, because I like what you said too in the book, and I almost like equate it to like an athlete, like how an athlete practices so much that it's just reactionary in the game, and like you talk to how the Marines, how you guys would train under such high stress that you already know how to act, and I feel like you can make a parallel to trading. That you're prepared to when, so like when it's time to make a trade, you think that's a fair comparison?
Yeah, I'm kind of an assassin when it comes to trading. Like it's very, like when you get to a spot where you can like incorporate or assimilate your intuition on top of a strategy, and you kind of get the joke, because this is kind of all a hustle. Okay, like let's just be real. Like, sit and watch all this BS. I mean, I don't know to what degree I can swear on here, but there's a lot of bullshit that goes on in the markets every day.
Exactly.
From algos, from people, from retail, from you know, Robin Hood, and you just gotta like learn to love the nonsense, you know what I mean? Or like enjoy the suck, as we say in the Marine Corps, just this crappy, like, are you kidding me type of bullshit that goes on, you know? And that's just, and that's just trading. And like, and it's kind of like playing poker, you know, like a guy draws a 2-outer on the river and he beats you on a 2-outer on the river. It's just, I mean, that's poker, you know what I mean? That's trading. Like you get Trump tweeted, you get Pearl Harbor, you know what I mean, by some surprise attack from somewhere. Yeah. Like that's why you got to manage risk. And like sometimes managing risk means that like you get stopped out of the lows, or like you buy a bad spot, or Bitcoin on Thanksgiving Eve, you know, smashes you down or whatever. Like I know all of them. Okay. Like it's just, I get it. So it's kind of like just appreciating that and just kind of like just being tougher than most of the others, because everyone's going through this at some level. And most people kind of just can't hack it, you know, because like it's not fair, or, you know, there are other like, you know, personal issues come into play, which is fine because it happens for all of us. But it's, if you don't have the training, if you haven't built the foundation, the psychological foundation, you haven't put in the mental capital, you haven't put in the quantitative capital, quite frankly, to really educate yourself and keep growing and keep evolving and keep, you know, having real earnest conversations with yourself, to have a support group. I think it's freaking tough, man. I think this is a tough way to make an easy living.
Absolutely. Yeah, well said.
Very true.
John, a book that you mentioned being very influential on you as a trader was D. Napoli Levels. I believe it talks about Fibonacci application. Do Fib still play a large role into your trading strategies?
From an overarching view, yes. Joe Napoli's work on, you know, D levels, trading with Napoli levels is just like a game changer for anyone that understands. I mean, this book was written like 1999, I think, or 2000.
Yeah, and it's still relevant, would you say?
Very relevant, very relevant. Because the concept that he talks about is basically, you know, spots to provide liquidity, okay? And where are these spots? And effectively stacking multiple overlaying independent structures into one structure, to where you have like a much higher confidence interval as to the efficacy of that trade, all right? And that concept, that principle, is still very relevant today. I think will be relevant for some time to come. So you might like apply sort of like the cryptocurrency trade, at least conceptually in that. Now, while it's not necessarily like fib based, but the idea that I'm going to take 2 or 3 or 4 prevailing macro narratives, I'm going to combine them on top of, let's say, you know, what's likely, you know, a very good momentum trade, followed by buying pullbacks with a strong trend in a sort of environment that's conducive to this. And what you get is these 4 or 5 different independent factors which support buying Ethereum, for example. You know what I mean? And like, okay, I have the fundamental, I have the sentiment, and I have the technical. So those things, like now how then can I tactically implement that? All right. And so that concept of what Joe Napoli taught was how to build a structure. Now then, how am I going to adapt that structure? How am I going to adapt that style to what works for me in my situation? That's the beauty of the markets, is that they're going all day long. There really are no day. Like you look at, you know, trading crypto during the Asian sessions, like maybe trading isn't best during US hours for crypto. The most volatile markets might come during Asian and European sessions, and that's a function of you to assimilate. And while maybe legacy finance people, living on the East Coast, I lived in New York for 8 years. I roll into my Midtown Manhattan office at like 8:15, 8 in the morning. We do our initial brief, 9:30 US equities open, okay, you're messaging people, you're calling people. Well, that schedule, frankly, is not conducive to trading crypto right now. You're trading crypto from your smartphone or from your living room, which is where I live. You know what I mean? Like, this is me, like doing this is my shtick, okay? And I go outside and play my golden retrievers, some days, like so I'm walking in the park, like whatever, because I was trading Ethereum all night long, okay? And that's just what the market is.
Yeah. Wow. So you're fairly active in crypto. Yeah. Like,
I mean, that is the macro trade right now. Like you're dealing with an institutional, you're dealing with a store of value trade that you can't kind of get in the way of, because you're dealing with institutional money. Treasury departments of institutions out there need to own Bitcoin and need to own Ethereum. They right now don't care if it's the most efficient crypto. They don't care if it's what it costs to do a transaction on the blockchain through Ethereum. They understand that broadly that they need to, over the next 6 months, 9 months, a year, have a 2%, 3%, 4% allocation to this, that if they're going to be properly diversified, this is what they have to do. And what you're seeing here in this market, I believe, and why trading's never easy, okay? But why it's been a more fluid trading market is because these passive buy programs from these institutions are coming in via the CME futures have given a lot of credibility to it. A lot of the adopters have given credibility to it. And the reality is there's a lot of people that still don't understand it, but they know that they have to own it in some capacity. And you have investment committees now making mandates for this stuff, and they have to own it. And so what that allows you to is, if you can find spots to provide liquidity, because let's face it, a market with this kind of returns is going to attract a lot of leveraged traders to it, because that's just what this does. And these leveraged traders at times become overexposed. And when they become overexposed and they get caught over their skis, they're forced to liquidate. They come down and they provide you with spots to generate liquidity. And there is manipulation that goes on, and that's fine. But it's about keeping your size in check, because you've got big institutions behind you, in much the same way behind the S&P 500. Passive flows now in the S&P 500 are a huge factor in determining overall performance when you have certain market regimes in place, i.e. perennially low interest rates. Look at that compared to the S&P dividend yield. When that's the case, you're an active portfolio manager. You're going to have to own the S&P, and you're measured against that benchmark. Step in and buy it in a risk-defying way. And if you're not greedy and you manage risk well, you put yourself in a good position to do well.
Yeah,
very true.
Yeah, John, Dan got Dan is the one who set up the interview. He's talked to you on the phone. He got back to me and he said when he talked to you about crypto, he was so pumped up. He was like, yo, the market wizard, he's trading crypto. He's like, it's here to stay. He's like, I knew it. Like he was all pumped up because these are the things me and him talk about, Yeah. And so he's pumped up.
1400. Ethereum was at 1400 when we talked about 6 weeks ago.
Yeah.
Yeah.
Yeah. So you mentioned Ethereum. Are there any other coins that you're active in trading?
Truthfully, because so much of my time is focused on just the futures. It's Bitcoin and Ethereum. I watch other coins from an ancillary perspective, but if you got me into my brother and my network, I tend to do more listening on the coins they're trading, the altcoin, stable coins, but just keeping an eye on, okay, how to get this kind of monster yield. And again, going back to the sort of Ethereum trade, because that is a market that I trade pretty actively and I'm in pretty actively. I just don't know how that market doesn't rocket till up to 10 or 15,000 per coin. There's so much institutional underexposure to it that aside from it's a trade, I think you can almost be too smart for your own good. Okay. You can say to yourself, oh, well, there's already 6 different technologies that are better than Ethereum right now at doing this. Yeah, but don't let perfect get in the way of better. Okay. And right now, the first institutional adoption is going to come in this way. And they're only in the first or second inning of that adoption. And they need to own this. They need to have some exposure. And it's kind of like the QQQ ETF or the SPY ETF. Well, I got to have something here, because right now, I can't tell my investors that I have no exposure to crypto. If I even tell them I have 2 or 3 or 4% exposure, that's defensible. But no exposure is not defensible. And it's going to lose me my job. Okay.
Yeah. Yeah. No, it's exciting times. It's awesome. It's awesome to hear this. This is, a lot of things a lot of us have been speculating on for some time. It's good to hear it, from someone like yourself.
It goes both ways though. Like I can't, like I'm saying this is someone that traded the 2000 NASDAQ crash that was in Midtown Manhattan in 2008 when the great financial crisis hit. All right. Like I get asked all the time, like when plumbers come to my house or, like I had a plumbing leak in my garage like 5 weeks ago, which was like, this is perfect. Like there's never a great time for your pipe to freaking burst. Okay. On your water heater. Right. So my pipe burst and like the loss mitigation team comes in and 3 of the 5 people like are on their smartphone trading like Dogecoin and asking my opinion on it. Okay. They're like, the guy's making 15, 16, 17 bucks an hour, which is a lot of Americans out there. Okay. And I thought it was an interesting sample set of like people who are looking to be more active in their investment portfolio. And you know what? If crypto is the gateway drug that causes that, even better. You know what I mean? Like the fact that millennials or people in their 20s now are enticed by crypto, regardless of how it ends. Well, hopefully it ends well, or hopefully, which I think this will. But I think that even if crypto, and here's the thing, I want to be clear about this, all right? There's a lot of people that were bullish tech in 99, 2000, but still lost everything when it sold down, okay? And so you can be bullish Bitcoin and ride it from 50,000 to 250 and still lose it all from 250 back to 200. You know what I mean?
That's true.
And that's just how this goes down. But I guess my point is that sample set and the continuous sample set I get from people asking me, oh, you were in Market Wizards. Oh, you wrote this book. What do you think of crypto? You think it's overvalued? I'm like, that's not the way this works, guys. It doesn't work like it's overvalued. It's like, it works that there's supply and there's demand, okay? And if the people who need to own it don't own enough of it, then you got a supply problem, okay? If the people who own it own too much of it, and you get rid of it, you got a demand problem because the people that they're gonna have to push down demand. Whereas if the people don't own enough of it, they're gonna push up, they're gonna drive up prices.
Exactly.
Okay. And that's
Thank
it.
you. You know what? We teach every day, and nobody in the retail, they never think about supply and demand. It's a market, right? So exactly, right? Thank you. I really appreciate that. That was beautiful.
This piece of dirt, like Las Vegas is the hottest real estate market in the country right now, okay? And this piece of dirt made of sand, okay? It's just sand. And by itself, it's just some sand. But the location of it, its proximity to downtown Las Vegas, its proximity to other key, convenient, desired areas, all right, is a factor that determines its demand. And there ain't much supply of Vegas real estate in the right locations, given all the Californians and other people trying to move here right now. And I don't care if, this house it's on is like only worth 300,000 in materials. If it's in the right location and there's not much of it out there, it could be worth $2 million for this house. Okay.
Exactly.
And I don't need to really hear what you think about, oh, well, the principal opinion that doesn't matter to me.
Exactly.
All that matters is what the market's doing and the supply and demand.
Exactly. I lived in Vancouver for 26 years. You had a 50 by 100-foot lot selling for $5 million, right?
Yeah. Yeah. Welcome foreign investors. Welcome the Chinese. Welcome, whatever. Like, I mean, they're doing it. Demand, supply. Like, that's it. I mean, however many Ethereum tokens there are. I mean, there's just not enough institutions that own enough of it right now. And as we're talking, I mean, I just don't listen. It can happen. There's going to be a wipeout move, but I would say this as well, that having been part of many wipeout moves to the downside, having traded COVID, having traded, the GFC, having traded the 03, 02 bear market, having traded 2000 bear market, like there's an ebb and flow when they stop buying the dips, okay? And this is where understanding optionality, understanding risk-defined structures and just being through these, that I'm looking forward to playing the down move in crypto as well. But that time ain't now. That time ain't now.
How's that now?
It ain't now.
John, so you live in Vegas, former bookie. You've played poker. You said you sports betted. You strike me as someone who might be interested in maybe some NFT horse racing. Have you been seeing any of that?
There really are only so many hours in the day and only so many days of life. But I do appreciate. I did watch the Kentucky Derby last week with my daughter, and I can tell she's got a little bit of the gambling bug in her. She's only 4. Okay. She was jumping up and down, and she liked the Hot Rod Charlie was her play in the Derby. And because when the announcer was reading down the names, like Hot Rod Charlie, and I filmed up a video of her like jumping up and down. And Hot Rod Charlie actually showed in the Derby, okay? And she was cheering the horse around, and like a few days after, they was like, Daddy, I want to watch Hot Rod Charlie. Although actually Hot Rod Charlie now got the place with the disqualification of the winner. So actually Hot Rod Charlie ultimately gets the place, although for ticket cashing purposes, she showed.
Right.
Which is all we care about. Okay.
Yeah, definitely.
Yeah. We don't care about if JP Morgan gets convicted or manipulating the silver market 5 years later when I'm stopped out in 2014. That doesn't do me any good.
That's funny. Yeah. No, there's nothing like it, man. The horse racing is exciting. I remember just me growing up being a kid. I mean, but I'm a degenerate now, but maybe that explains it. But it just and even just the virtual, we got some in the stable now. We've been racing them. It's it's fun, man. It's unique, interesting things going on. I guess going back to traditional markets now. Another thing,
because the traditional markets no longer trade in a traditional way, right? They're between smartphones and futures and the impersonal nature of it, or much more impersonal nature, or what's conducted over Twitter now. Like people trade ideas on Twitter, and can you trust it? And man, if I put $500 in this coin, I could be a millionaire in 3 weeks. You know what I mean? These are special. There's nothing traditional about that. Okay.
Yeah, sure. Well, let me ask you this: you talk about the market narrative, the prevailing market narrative, and how important it is. Can you delve into why that's so important? And then two, what do you think's, what's the market narrative right now?
Sure. Market narrative is really important because there's a few things that that are generally conducive of rising stock prices, rising asset prices. Okay. That's access to liquidity, economic growth. Fed policy kind of falls into the first bucket in terms of access to liquidity because the Fed plays a role in that. But then you can also deal with idiosyncratic factors, like maybe, mortgage lenders are facing certain fiscal regulation that could be inhibiting things, or tax policy that comes into play. And so when you size those things up, all right, what is monetary policy right now? Largely conducive. What sort of fiscal policy do we have out there? Largely conducive. What are people's, attitudes and overall profitability? Well, we're making new all-time highs almost every day, in these things. And so, for passive flows out there, as people decide, okay, and how am I going to put my money in? Well, I want to save because, rates aren't frankly returning, the sort of the kind of returns that you can get that are conducive to living in a world that sort of has the inflation that we're seeing right now, And so when we talk about market narrative, we're looking at, all right, what's at play? Is it, how convicted can I be around a short trade when the Fed is committed to lower to long and the Fed is committed to seeing inflation take place? Well, I might be able to be convicted to a curve steepening trade if I want to short 30-year treasuries, maybe by the 5-year treasuries, because that shows sort of where the Fed is not going to touch interest rates in the short term, but they'll let inflation run wild, which will obviously cause which should cause the curve to steepen, all things being equal. But that's what I mean by the overall macro narrative. On applying that to the cryptocurrency side, the narrative is institutions need to own this stuff. Institutions are systemically underexposed. They are fundamentally underexposed, okay? And so in a market like that, when you have that kind of systemic underexposure, you do not, on balance, want to be selling dips, okay? On balance, you do not want to be selling dips, all right? On balance, you can be tactically short. I don't mind you selling new highs, okay? And very tactically, but I'd rather buy dips or buy liquidity events on the downside, like what we saw in Ethereum yesterday, where it sells down 10 or 12% in a matter of, an hour, okay? Well, that's a spot where someone's probably, again, it's all easy in hindsight, okay? But I'm trying to give examples to sort of draw a parallel to, and that is, was there some fundamental news that came out? Was there some regulatory risk? So I'll get back to the market narrative right now. And on balance, with the adopters, with the institutional adopters we see, with Goldman Sachs, with these people who are needing to own this stuff, understand how politics works in this country, okay? And let's just think about what threats exist to cryptocurrency. And the biggest thing that comes to me is it becomes just outlawed, okay? What is the regulatory risk? And I say to myself, well, both Democrats and Republicans can be bought and paid for in the White House, all right, and in Congress. Let's not kid each other, okay? And is there enough special interest money via crypto from not only the people who are the originators of it, but I mean the institutions who are adopting it, a broader scale. And what exists now, which didn't exist 3 years ago, I think this is embedded in the crypto narrative, is the institutional mandates out there. And Wall Street has it is freaking in bed with freaking Washington, D.C. in all aspects of it. Republicans, Democrats, all right? Washington lives on money. K Street lives on money, okay? And Wall Street is more than eager to support that, especially now with their well-heeled pockets from the cryptocurrency. So any attempt to legislate or any attempt to like discredit, all right, or combust this crypto move through greater taxation on crypto profits, which some bullshit they're talking about. Like, yeah, you're gonna tax crypto at a higher rate, sure, right? So you know, like, come on, you know, and there's some gamesmanship in this because you know, if I'm an institution underexposed, I don't mind dropping that headline out there, even though I know it's not true. And like maybe I get a 10% pullback.
Exactly.
You know, like you gotta like your bullshit meter has to be really high these days with these headlines and with this news and all these disparate information sources. So back to your question about the narrative. The narrative is the fundamental sentiment, the fundamental view that the market holds as manifested by the position and by the price action. Okay. And the narrative right now that's winning is crypto is not overvalued. Crypto is a destabilizing force that Wall Street is fundamentally underexposed to. And as long as that narrative is in place, then you need to be buying the dips. You need to be providing liquidity on these liquidity events, period.
What I'm a newbie to crypto. I'm an old guy, and having had a heart attack, I only just trade futures because it's relaxing. What's the right?
Relaxing.
Well, I mean,
relaxing.
I'm used to manipulating 20 different stocks simultaneously. But the thing is, I was just curious, what's the price action like in this Ethereum?
It's phenomenal.
I mean,
it's absolutely phenomenal. Like it has a range. Really? Yeah, you don't need much leverage. In fact, the futures behind it to give you some leverage, but you're talking a market that has, you know, a 600 to 1,000 basis point range every day. Even a 2-to-1 leverage, just think about what that equates to. You know what I mean? You're talking to 12 to 20%. And there's plenty of liquidity for what you're trying to do, for what most of us are trying to do out there. Now, if you're trying to build $1 billion position, don't send a monthly order, you know, but if you're trying to, you know, maneuver and make a living, you know, between the fractional ownership aspect, which exists, which is a much more efficient way, between the, in a credit to the cryptocurrency exchanges for facilitating that and making crypto ownership much more accessible through this fractional ownership, you know, mechanism, and through the micro Bitcoin futures. Now they need to come up with a micro Ethereum contract as well, which I'm sure is going to be imminent. The CME loves their exchange fees too much to not do that. And I said that as a CME IOM member, okay? But the fractional ownership allows you to get more granular with your risk. So the idea that you can say, okay, Bitcoin is really volatile, but it's not about that Bitcoin is $56,000. It's the fact that I can invest $10,000, and then at the end of the day, I can buy a nice dip, or I can buy a nice pullback, and it could be $11,000. And if you look at it like through that lens of risk management, then you're fine. If you look at it like, oh, I can't afford it because like Amazon or it's a $2,000 a share, well, then you have a problem. Okay, but if you look at it, I can put 10,000 in and I can own 0.74 Bitcoins, or I can own 0.24 Bitcoins, and I can get out 11,000. Then I think that's the right perspective.
Cool. Thanks.
John, you mentioned the software that took you a while, and I think you mentioned you had help doing it. MPAC, it was an acronym, which you use for execution. Do you consider yourself a discretionary trader? This just executes the trades for you, or are you maybe a blend of both, systematic? Just a little, and obviously I don't need you to go heavy into detail. Just a little bit around your process.
My problem. Ray. Yeah. No, I'm sometimes of a hybrid approach, but I'm a very qualitative, holistic trader that's built upon a fundamental conceptual foundation of what I look for, and utilize technology to help execute that. But I'm the guy that's kind of pulling the levers. You know what I mean? Oh, go 2x on that strategy there. Go half x on that strategy there. Incorporate this qualitative news event relative to these idiosyncratic factors, whether it's the last day of the quarter or triple witch expiration, or the fact there was a bunch of margin calls that existed over here, or there's a halving event that took place. You know what I mean? There are things that, yes, you can back test, but I also believe that there's like these really unique one-off events that are not back testable. And I actually eagerly seek those out that are non-back testable events, because it's kind of like a wild poker table. I want to, my battery's running low here. I got to go to a charger. I want to be at the wild poker table where I got to make a 3x call with 6-7 suited, because I know if I pop it, I'm going to take the guy's stack. Okay.
Right. Yeah. Good analogy. I like it. Yeah.
Yeah. No. So But guess what though? If you can't read people and you can't read situations,
Yeah.
you gotta play your top 10 hands, your aces through tens, ace king suited, you know, maybe you call from position with like your mid pocket pairs, or maybe, you know, you can use some game theory to, yeah, I would even say that. But if you don't know people and you don't understand, you kind of got to play close to the vest. You know what I mean? But I'm the guy that wants to be at the wild table, okay, with all sorts of nuance, all sorts of like left field events that happen, because that's where my edge is. You know, the less back testable something is, the more qualitative, the more holistic something is, I want to be involved in that market, okay? Because it requires you to think fast, assimilate some information fast in a way that's unlikely to be readily programmable.
Sure. I like that. That's very unique, and I understand the comparison, like the poker comparison, perfectly, because it's like, you know, for someone like myself, I'm like poker wise, right, and even like trading, I try to be, you know, systematic as possible, but then you know, deviate when new circumstances come, where you like to get beyond the game tree, like, no, like let's get far out, like to where no one knows what's going on. I really like that. That makes a lot of sense. How much, like, so before you had this software, what have been the biggest, like, I assume this has been a humongous or a big input, you know, boost to your trading. How did you handle it before having
Sure. So what impact software is impact stands for market price action. Okay. And it allowed me to like trade economic events and Fed events where there exists a lot of gap risk. Okay. For a lot of people, when the jobs event comes out, you know, they'll minimize positions. But I actually like learned a lot about these economic events, how markets are positioned around them, what they're expecting, and how they influence markets. And then I took all that knowledge over 6 years and applied that with a number of like execution trade secrets and built impact software. Okay. So that software allows me to, at a very primal level, manage event risk. But then, as you can imagine, like, it's kind of like, you know, when you start to build something like, oh, I know what I want to do. I want to build like a 6 by 8 foot slab. But then by the time you're done with it, you have a 3-story house built on that 6 foot, 8 foot, you know, cement slab. Okay. And so you kind of got to tear the whole damn thing down at some point, and like take the concepts and rebuild them from scratch again, because you've kind of gotten ahead of yourself. But at least that idea of programmatically attacking a factor or a strategy in the market, then spun off to do other things algorithmically as well. But nonetheless, I'm still largely a click trader that uses technology to assist me, but I'm not the guy that like sets something and walks away for 3 hours and looks from my smartphone from my yacht and checks my profits. You know what I mean? I'm a guy that's like being around, because so much of these opportunities are fluid and are happening at 2, 3 in the morning sometimes. And you know, I mean, hey.
John, we've talked about the importance of risk. Risk, if you don't have an edge, then it's, you know, we're almost talking, you know, there's no point of even talking about it. For the listeners going out and like listening to this, any advice on finding an edge?
Yeah, no, find yourself. So first of all, I'd say when you want to find your edge, you're the edge. Okay. Mm-hmm. What you have, and I talk about this in Global Macro Edge, what you have is unique. Your perspective of the market is unique. It's not necessarily atypical insofar as like, man, it feels like the market's kind of heavy here. That part of it feels like the market's kind of light here. That part's not unique, but your life experiences, what you've learned, what you discover, there's lots of little nuances that exist in trading, even on the most broadly traded markets out there. But if you go to markets that are not maybe as broadly followed, your experience maybe in the healthcare industry as a nurse, or your experience from having dealt with working at a semiconductor firm, or your experience in just following this one, maybe the Russell 2000 contract, okay, and how it responds at this time of the day or whatever, you can establish something that you can make your own. And even one strategy that you really get granular on, you know, an inch wide and a mile deep is what I say, okay? Get an inch wide and a mile deep in whatever you're doing, all right? And really drill down on what your edge is. If your edge is that you work a part-time job, like probably a lot of your listeners do, and trading is just simply supplemental for them, like for a lot of us have been in life. I mean, I was there at a time. Mm-hmm. Then, you know, what times can you trade? Well, if we're in a period of price discovery now in crypto, you know, what's your best bet? If Ethereum's going to 15,000, then maybe your best bet is, or you think that, I'm not guaranteeing that, but if you think that, your best bet is to do a little buy and hold, understand stuff, and then share the strategy with someone else, and you can start to use OPM and other people's money. So like, I think that part of it is your edge is both one, what market potential you see from doing your own internal deep dive analysis, and two, how you can manifest that into a real business. Because if you can then take that edge and scale it, you have something really special to where now you can make this a living.
Mm-hmm. Love it. Beautifully said. I love how in the book, how you relate to emotion in trading. And it's almost it's like using our emotions as a contrarian indicator.
Sure.
You know, because like, you know, the human mind, like, I don't think evolved to do these, you know, gamble in a proper manner. Can you just talk to like you know, how you use these emotions? Just tell the audience about it.
Yeah, I mean, I've spent a lot of time working with performance coaches, you know, in terms of trying to understand. I mean, I've gone through hypnotherapy. I've gone through a lot of journaling, over 18 years of like trying to manifest every mental edge I could possibly find. Okay, because like, let's face it, guys, our brain is our biggest asset here. All right, that's sort of what we, you know, we are in an information business.
Exactly.
And so, like for me, like understanding, like, am I feeling like fearful? Am I feeling like in a place of calm confidence? Like when it comes to like the biggest trades, like I tend to have this like real calm confidence about how this is going to go. If I start to get a little too greedy and feel like, man, this trade can be blah, 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 that's a sure sign I probably like just bought the high tick, you know? And that happens to me. Like I've been trading for 20 plus years. I'm a market wizard, you know what I mean? Like whatever that means, you know? And so like the fact that like I can like buy a high tick and feel like, oh my God, I'm about to make a bunch of money. And believe me, I'm sufficiently self-aware of these emotions that I like, I've done a good job of not letting them like, you know, override my risk management process, but still, or it's like, man, I'm feeling a little fearful here. Like this is kind of a little, if I'm feeling fearful, then I know others are feeling fearful because I'm pretty freaking salty. Okay. So damn, if I'm a little bit afraid to be long here, there's other people afraid. So we got to be very careful and just kind of watch how this unfolds, you know, and go from there. But then other times, like I just get dialed the heck in. And when I get dialed in and I'm just feeling the market, I'm internalizing the market price action, and I'm thinking 2, 3, 4 steps ahead. I'm in that place of calm confidence where I can just, you know, where I'm dealing with the corded part of my brain, not the amygdala. And I'm just like analyzing everything in an effortless, fluent way. I know I'm kind of in that zone. And that's the time I want to like really focus on and really do things to keep me there as long as possible, because it's usually a very profitable place.
Mm-hmm. Excellent. What did you, I mean, we've talked a little bit about, you know, I guess we haven't, we've touched on like Robinhood, Wall Street,
Right.
like these communities getting together, you know, FOMOing into stocks. Very unique. What was your perspective, your take on all this? And if you're making adjustments, maybe to your strategies or to the environment?
Yeah, truthfully, like I follow the stocks only just kind of answer like the GameStop thing that went on. You know what I mean? I just didn't, you know, I trade, the futures just keep me so busy. And it's like, and I watch stocks and I pay attention to them, but like, is it what's effectively like sort of like my own self kind of CTA, you know what I mean? In terms of like, I trade these major, you know, 6 asset classes, 35 futures contracts, and the corresponding weekly and monthly options on those contracts. Like, I don't, you know, and I watch the crypto, but like, there's just so many hours in the day, and just trading like Ethereum futures or Bitcoin futures, or trading, you know, fixed income futures or whatever, like, man, there's enough to keep you more than busy with that stuff. And like, I'm aware of it, but it just, you know, I don't run a hedge fund. I'm not, you know, I mean, I'm just talking about me here. So like, that's like, I'm aware of them and like, good. I mean, I think anything that gets people into the markets and educate themselves in the long term is going to be beneficial. And you know, if you need to learn about risk, buy my book. I don't know what to say. Like, it's just
no, they do. No, those kids do need to learn about risk, John.
Yeah,
So if any of you guys go get his book, go get this guy's book. Tell the listeners about your book. What made you write it? What's the content inside?
Sure. The Global Macro Edge, Maximizing Return Punitive Risk, is really, you know, it's a 600-page book that's gonna be 5 years to write. I wrote it from 2011 to 2016. It's my heart and soul. It underwent a number of iterations, but literally have 14 different market practitioners. I had my track record audited where I took $100,000 and what seems pale in comparison to these crypto returns we see now, made 3.1 million on it, had those returns audited over 6 years, but started with 100K and made whatever, you know, whatever that, sorry, that was my frying pan. Made, you know, did quite well. But again, the key was that I was an author that did these returns and I walked people through the process and had the audited returns to sort of back that up, that this is what I've done and this is what I strongly believe in. You know, to say that they will work going forward, we have to put the necessary disclosures out there, obviously. that, listen, you know, I've done this, hopefully it works going forward, but this is what I've done. These are the returns I've gotten, go from there, you know, but it really covers three things, you know, it covers, you know, strategy creation, all right, or regime recognition, which is where we talk about the regimes, how we recognize regimes, the strategy creation, which is now you know the regimes, what strategies work in those regimes, and ultimately execution. Well, now you know the regime, you know the strategies, now how are you going to put those strategies into place? And so it's really a comprehensive look from soup to nuts that will benefit a money manager, someone who wants to become a professional hedge fund manager, benefit an investor so they know what questions to ask, and ultimately benefit an advisor who wants to consult and refer people, hey, this manager is good, or hey, this might be a nice investment fit, and here's the metrics I use, specifically the Netto number, which I talked about, that, you know, return per unit of risk. Well, if you have that $1 million portfolio and you have only 200K that you can risk, well, your Netto number is going to be different if you generate a 20% return with only a 200K risk budget on $1 million than the guy who actually could lose the entire $1 million. Because don't you admit that if you gave me two choices, I'd rather have the guy that had that risk budget and define the risk, who made me 20%, than the guy that had no risk budget whatsoever. I mean, one person demonstrated under tremendous skill and he had, you know, less flexibility, whereas the other person had no, you know, no constraints on him or her.
Mm-hmm.
Exactly.
What year did you write this book?
2000. Well, I wrote it from 2011 to 2016. It came out in late 2016.
Okay.
But the principles and concepts are like as good as ever, you know.
Yeah. Well, because, you know, I was just reading the, you know, like the description, and the reviews were great on the book, by the way. They talked to you, like the detail you really put into the book. Obviously that thick of a book, I'm sure you did. It said in the description, you say that today's markets offer fewer opportunities. I was just curious to what that, yeah.
Yeah, no, what I actually busted. So what the book does is bust the 6 biggest myths out there. One of those myths is that there's fewer opportunities.
Oh, okay. I misread.
That's a myth. I'm saying there's actually more opportunities, not fewer.
Sorry. Yeah, I misread.
No worries. So those 6 myths are, you know, more risk equals more return. Actually, it's smarter risk that equals more return. Okay. Emotions are our biggest enemy. Actually, they can be our biggest ally. Okay. Compensation should be based on returns. No, compensation should be based on returns per unit of risk, not just based on your returns. Okay. And so I walk through these, like the 6 biggest myths, or at least what I perceive to be the biggest myths on Wall Street at the time. And I talk about not only the problems they cause, but then how to solve those problems and how to bust those myths completely and recalibrate the way you approach and think.
Mm-hmm. I love it. Now it's great. You guys go out there and get the book. We're going to get it. I mean, just you see how this guy's brain is just firing all over the place, all this into a book.
Let's play Pepper, baby. We're playing Pepper. You know what I mean? There's no script here.
Yeah, I know. I love it. You come out in Vegas, man. I know we touched on some of the gambling activities you have done. Is there any recreation gambling activity that's your go-to right now?
You know, the pandemic kind of ended that. Like, listen, man, like I got vaccinated a couple of months ago, but like, I'm just saying, dude, like I enjoy playing poker casually, you know, once in a while, but like, dude, I'm not, I didn't go and play poker. I didn't need it that bad. You know what I mean? It's just,
yeah.
I mean, I got a daughter now, and I mean, my life, and, you know, I was going to law school, and so just at night and stuff. So like, I mean, I'm just always trying to learn stuff and trying to grow. And right now, just like blowing up law professors is kind of my hobby at nights. You know what I mean? It's kind of like,
yeah.
You know, like I mean, I'll end up being a licensed attorney one day, but only for fun. So maybe I can testify in this, or go in front of the Supreme Court one day and like take down big tobacco or something, just as a hobby, just because just the cerebral gymnastics it would take to, like, you know, go and like litigate some like monster case and be in like this big courtroom or argue some sort of constitutional law in front of the Supreme Court. How cool would that be?
Yeah, you'd be the man. No, I thought it was funny how Jack was like, yo, this guy has time to do law school and to do all this. Like, how do you manage doing both? I mean, what's that like going to law school? Like,
but it's fun. It's fun because like you're sitting there, and like a lot of trading is like you're building this thesis, you're building this investment thesis, you're putting together your arguments, you know, and you're looking for holes in the arguments, and that's really not much different than like trading.
Yeah.
And you know, you don't know the outcome necessarily, and there's a lot of qualitative sort of fuzzy stuff, and when you come to that, like, you know, persuading a jury, like you got to handicap this jury. You have to like understand, you know, pre-existing statutes and pre-existing, you know, cases and how they influence things, and understand psychology and how you're going to negotiate with opposing counsel about, you know, what their case is, and empathy is a huge factor. Like I need to empathize with what other market participants are doing in the same way I empathize with what maybe opposing counsel is thinking, or what, you know, the defendant's thinking or the plaintiff is thinking. You know, what's their deal? What are they trying to hide? You know what I mean? What are they a little too willing to volunteer? What are they not so willing to volunteer? You know what I mean? So it's just another extension of playing poker, you know, just going to law school.
Exactly. I've had the same thought, John. I was like, man, like a really good poker player, a really good trader, just a really good strategist in general.
Yeah.
It would make for a good lawyer, right? It's just all strategy.
For sure.
Like you're saying.
And when you do it every day, like our brain stays sharp. You know what I mean? Like when you're around this all the time, we're engaged in our, you know, we're not caught in some mundane, repetitive kind of job, pedestrian job. It requires constant thought and constant, you know, evolution. And so when I get into these classes and like the professor brings something up, I have like, you know, I'm 46, I'm older than half my professors in there. So I'm bringing up these real world cases, like, well, professor, blah, blah, blah. You know what I mean? And I think of all these situations because I'm a risk contingency guy. And I'm like, you know, it's cool. And like, it's like, man, I'm not fucking with you, dude.
Where were you? Like, where were you?
I've had like literally classes. Go ahead. I'm sorry.
Where were you when I got my Wells notice? Jesus, I could have used you.
You don't want me for that one, brother.
Have John Netto represent you. Yeah.
That's you know, there's a.
Yeah, no, John. I thought just like to, you know, for us that like do this for a living. I've always thought it's like, man, it gives us like, I think, an edge in certain situations in life. Maybe that's just me being biased on us, but I just think the way we see things and like you say, like staying sharp and processing, like we can have certain edges in certain situations. Like even just me dating girls, I can't turn it off. I'm thinking, what's the optimal strategy? Where do I take her? How soon do I, you know, you think of all these things. What's GTO here?
Yeah, what's GTO for sure. I'll tell you what, like wow, that's a great, I think when it comes to like everything but relationships, even relationships, that's how I approach it as well. Having gone through, you know, I think we've all gone through tough personal situations, tough relationships that didn't work out like we thought, which, you know, is probably a metaphor for business in general. You know, there are trades that you really think are going to work out well, they don't. The other trades, you're actually quite surprised how well they work out. You know what I mean? And that's probably a microcosm for sort of, you know, dating or marriage or life, and whether it's with your parents, your son, a new friend you made, etc. But I would say that, you know, there is that constant assessment of probability, and that is the way I think too, you know. But I would say this, that like for the people out there, like focus in your relationships on the connection that you have with people, you know. And connections come naturally, or they come from like actively listening and being empathetic to like what that person is, and thinking more like we before me. Okay, so and I think one thing that I've done well in my Wall Street career, my trading career or two things actually, is one, identify talent, and the second is provide value in a relationship. So I've met a lot of really talented people that have taught me quite a bit, okay? And I think I've done them right because where my moral compass sits, all right? And I've done the best when I've thought about we before me. And when you think that way, I've found that a lot of good things tend to happen.
Mm-hmm. Yeah, because I can see as well how like sometimes, you know, I've had people be like, oh, Ray, you're always, you know, almost like I'm cold or something. It's like, no, I just know I know probabilities. I know I know it more visceral than most people, and it can come across in that nature. And it's like, I'm just being realistic. I'm not, you know, but that's great advice. Great advice. John, favorite market wizard in the book or someone's chapter you really enjoyed?
Ooh, I read every chapter in the book. And the name, God, the previous chapter to mine is the one I enjoyed the most though, because the guy's name is an Indian gentleman. I actually talked with him, really cool guy, really sharp. And our style, I think I was chapter 6, he was chapter 5, or I was chapter 7, he was chapter 6.
Oh yeah.
But his
Dalji, I don't know.
Yeah, no, he's cool as fuck. He's cool as fuck. And he actually takes a very similar macro approach that I do. We actually subscribe to some of the same institutional research in there. And we have some similar war stories about trading the macro futures markets. And, we've synced up a few times and I really enjoyed his chapter. In fact, honestly, when I first read his chapter, I thought I was reading my chapter. When I first hit the book, I was reading, open to a page and I'm started reading, he's talking about trading Eurodollars and this news headline hit and how he's assesses the news headlines and stuff. And I'm like, oh, and I realized, oh no, wait, this isn't my chapter's in 6 pages from now or whatever, so I actually liked his chapter quite a bit, and I would identify with him in terms of the unknown market wizard side. In terms of the known market wizard side, I'm probably deferential to Paul Tudor Jones.
Yeah, Paul Tudor.
Yeah, PTJ, PT Jizzle. Doing it.
Yeah, I feel like that's one of like the chalk answers, but it is. He's
a chalk answer. It's a chalk answer.
Yeah, man. It is. You know who I always go to? Man, I love Ed Thorpe just because his dude hit the roulette to blackjack.
There's no wrong answer, man. There's no wrong answer.
There's no wrong answer. No. But yeah, man, no, we'll have to get we'll have to get him on the podcast because that's what we're doing. We got you. We've had a few of them on. And Jack did a great job. I mean, all you guys have been great interviews. JJ, anything else for our man before we get going?
No, it's been great having you on. I love it when we can bring someone on who, pulls back the curtain and gives the retail folks some education. It's really great. Thank you so much for sharing your insight with us. We really appreciate it.
Well, thank you for facilitating that. This doesn't happen if you guys don't, you're the conduit to the audience. So thank you for thank you for sparring and playing pepper. You know what I mean? It was great. A non-script, extemporaneous interview. Good stuff all around, man. Good work, guys.
No, man. Awesome, man. No, we appreciate you just sharing all your knowledge, man, all your wisdom with us. Thoroughly enjoyed it. And that's going to conclude today's episode of Confessions of a Market Maker. If you guys enjoyed the episode, please rate and review it for us. If you guys like to join JJ and myself and a professional group of traders, join us at microefutures.com. John, tell the listeners where they can find you. Anything else you want them to know?
Just Twitter at John Netto. Pretty straight. JOHN and buy the book. All the profits have gone to support service dogs for military veterans. So getting great market education and helping a good cause.
Absolutely. All right. So for John Netto, I'm Paulie Walnuts. He's the gorilla of House Streets. Make sure you're using stops though. All right. Peace.
Just saying.